Hi, I'm John McConnell, President and CEO of Victoria Gold. Victoria is a TSXV listed company, publicly traded under the symbol VGCX. We're a producer. We have our flagship asset is the Eagle Gold Mine in Canada's Yukon, where we'll produce roughly 170,000 ounces of gold this year. We're looking forward to year after year increases in that, peaking out somewhere above 200,000 ounces per year in the foreseeable future. Our all-in sustaining costs year to date are about $1,450. We've been focused on meeting our production targets. Now we're having a hard look at costs, and we hope to drive those down a little bit, but I think we're in a new reality of increased costs, and the industry average around the world now is probably closer to $1,450 than it was 4 years ago when we were around $1,150.
Well, John, welcome to London, first of all.
Thank you.
Good to see you here. Now, you're doing the rounds, are you? There's a conference on, but you're also taking the chance to see a few shareholders, investors.
Yeah, I'm seeing a few people here in London. Was in Zurich last week. At the end of this week, I'm in Frankfurt.
Yeah.
We have a large number of shareholders in Germany, so it's a great opportunity to give them my annual update.
The annual update. And the quarterlies are very much firmly fixed in your mind at the moment, which I want to talk about in a moment. But I'm kind of interested today. What I would like out of today's session is to understand about building companies, aiming towards Project 250, I think last time I spoke to you, and how you go about doing that in an environment like we're seeing at the moment. One of the numbers that stood out from your introduction was 1450 as a new base for cost of per ounce cost producing gold.
Yeah, no, I know shareholders are unhappy to hear that, but as a result of COVID, we've seen labor costs increase by as much as 30%. Fuel costs are up 30%. We're at the end of a long road to the north, so fuel affects all of our costs, because of the transportation of stuff to the site, our employees in and out of site. Our explosives are ammonia nitrate and fuel oil, so they're directly related to the price of fuel. And the biggest cost of producing cyanide is fuel. So, yeah, we've seen major increases over the last 3.5 years. Caterpillar parts, for example, are up 40% year to date. That's just this year alone. So, yeah, it's tough, this environment.
I was kind of hoping price gouging had stopped and we kind of fall back to a kind of baseline, but it takes a bit of time, obviously, and obviously, salary costs, that takes a long time to kind of fall away there. So
that never falls away. Once you make those increases, it's very sticky.
You hear that, Tom? So I want to talk to you today. Really, in fact, let's stick with costs and margin, because margin's what it's about. Business is about margin. So go talk about your quarterly numbers, and then I want to kind of get into some of those numbers.
Yeah, I think the biggest thing for me is we're cash flow positive this quarter. I think free cash flow was plus $18 million, and that's with making our ongoing debt payments. And we made an acquisition during the quarter, and we had the opportunity to pay for it in cash or shares of Victoria, and we chose to pay in cash. So I think that gives you some sense of the comfort we have with our balance sheet today.
Right, okay, because you ended up with sort of net income of about 5.65% net number there. But so how much was the acquisition in cash?
The first payment was $8.5 million.
Right, okay, chunk. So kind of bumps the net of effective net a little bit higher. But margin. All businesses need to make money going forward. So you can rely on the gold price, but it's taken its time. It's around 1975, getting to 2000. That will do a job for you next year. In the meantime, the things that you can control are what? Where are you investing your money? Where are you saving your money?
The thing we control, or I can control, is that the mine runs properly. That's first priority. Safety, then production. And if we do that right, we'll make money for our shareholders.
Right. But come back to the money thing, because it's really, really important that shareholders, current shareholders and new shareholders looking in, understand that this company's going to be around to do business. Right? I see a lot of companies struggling. Certainly, you talk about the developers, even advanced developers, balance sheets blowing up, cost overruns on studies, etc. It's tricky out there. As a producer, you're in a lucky position where you're throwing off some cash. There's some free cash flow. In your case, there's ways of allocating your capital or reinvesting your capital effectively. So what are you doing on that front?
Yeah, our primary focus for cash is to pay down debt.
Right. Well, how much do you owe?
Just over 100 million.
Right.
Well, almost 150 million Canadian.
And how long are you taking? Do you envisage taking to pay that down?
Yeah, the term facility is the one that we pay quarterly, and if memory serves me right, we have 4 more payments to make, so the term facility will be fully paid by this time next year.
Right, okay.
Then we also have a revolving facility we've drawn about 120 million on, and we'll start to make a big dent in that in H1 of next year.
Right, okay. And how do you plan that out? How do you sequence? I want to talk about sequencing of operationally, but first of all, I want to talk about sequencing of your balance sheet. So you are paying down on the term, and there's the kind of revolving facility there, which is good news. And you don't necessarily want to get rid of all of your debt. It's not a bad thing to have on the balance sheet. But how are you managing that side of your balance sheet? What have you done to kind of fix things?
Well, the other thing we've done is a little bit of financial engineering.
Right.
We've done some hedging for 2024.
Right.
We've sold some gold forward as well. We've bought some puts on the downside. So we've protected ourselves that if gold price was going to drop to, say, $1,600.
No.
At, our current operating costs and that, we'd be able to continue to meet our debt. Payments.
So it's a sensible thing to do.
We've protected our shareholders while, we've, lost 20% of the upside. Our shareholders still enjoy 80% of the upside on gold price.
Okay, it's the right thing to do. I didn't mean to be facetious there, but it's for 1,600 gold. A few years ago, that would have been lovely. But right now, I think the expectation for next year is that it should start moving through the phases. The economy doing what it's doing, printing of money, surely this is the time for gold to shine. Do you have a view on that one?
Well, I have 2 cocky answers when people ask me my thoughts on gold price. One is I'm a miner, go talk to an economist. The other is if I knew what gold price was going to be, do you think I'd be working 100 hours a week, 7 days a week? I'd be on a beach somewhere and
telling fortunes.
That's right.
Okay. No, but you must. I think when you're speaking to the bankers or even any of the kind of financiers that you go on these road shows with and talk to when you're on these road shows, they must be like pro gold. Are they more excited about gold than they've been for the last 3 years, or was it more of the same coming forward?
Yeah, certainly it's refreshing to come to Europe. Not so much in London, but certainly, the Swiss and the Germans are very bullish on the price of gold.
They love gold bullion.
Yeah, they love it. And, I don't know how many times I heard $3,000 gold in, 2024, and it just brings a big grin to my face.
Right. Yeah, I bet it does. But back to the business. So the balance sheet, you've done a few things to hedge the downside, but leaving enough of the upside. What's that, about 20, 80? Is that the kind of ratio? Right, okay, so that sounds sensible. Operationally, now you were kind of affected by some of the sequencing from this time last year in terms of the mining. So in terms of the ore that you're processing, lower grade, 0.65 versus the normal 0.89, it says in your news release. What happened there? Was that avoidable, or was it, unintended? I mean, what happened?
Nothing happened. We mine to plan. And if you look back at our technical report that we put out in early Q1 of this year, we forecast that we'd have lower grades in Q3. It's a sequence of, the mining process. And, the one nice thing about Eagle is it's a very continuous ore body. The grades average between, 0.65 and 0.85. Very consistently. The negative thing about Eagle is we don't have a jewel box we can go to where we're having a little bit lower quarter.
Yeah.
We can mine a few tons of high grade and, balance everything out. So, but personally, I prefer having the consistent grade.
So this is a kind of systematic approach to the mining rather than, I say, having a jewelry box that you can go to. Did you use ore sorters? Is that a thing at this sort of level? No, it's too low grade.
No, and I don't necessarily think the ore sorting technology is that great yet. So
or color coding, isn't it?
We use some innovative technologies at Eagle, but we deliberately stuck with tried and true.
Right.
When you're a single asset company with a mine in the Arctic, you want to make sure
don't need surprises.
Yeah.
Right. Okay.
Trusting new technology was not one of the things I wanted to do.
Okay. So in terms of the kind of operational side of things, what are some of the things that you have discovered that you can do better or are doing better as a result of getting on? Because when we talked back in the day, we're talking about, the heap leach and the stacking in winter and all of those sorts of things that you had to get through. So what's working for you?
Yeah, I mean, our biggest bottleneck has always been the crushing, conveying, and stacking system.
Right.
Through COVID, it was very difficult to make any changes.
Right.
We couldn't get vendor experts to visit site. We were faced with doing things over videos and stuff, and it wasn't very effective.
Oh.
But now we can get people in, and, we've redesigned a number of areas in the process, and that's working. And I would say almost on a weekly basis, we make improvements to the system, whether it's a different type of liner or adjusting a chute angle, those kinds of things. And then in the open pit, you got to make sure the guys are following best practices. It drives me nuts if I'm touring the pit and I see one truck stop and pull over so another truck can go by. That means the roads aren't wide enough.
Right.
So get the roads wide enough so trucks aren't stopping. They're continuously in motion. Similar when there isn't a truck being loaded. Drives me crazy to see the shovel operator teasing around with muck and, piling up a little here because that burns fuel.
Yeah.
If you're not loading a truck, shut the shovel down.
So just keep moving.
Yeah.
Just keep moving. So it's an efficiency process.
That's just productivity. We've put in a fleet management system now.
Yeah.
So we monitor the trucks and the loaders very carefully. The foremen and the shift bosses, they get regular readouts of exactly what's happening in the open pit, which trucks are less productive than others. So, those kinds of things are just starting to take effect, and we'll start to see improvements in operating.
Can you, with those efficiencies that you're implementing and tweaking, every day, and I'm sure there's fires you're putting out, most days as well, because that's just mining, right? But if I'm a shareholder looking in at this, whether I'm a new investor or a current investor, I'm going, okay, I can look at that quarterly. I can accept that the current margins as they are because there's a new paradigm. There's a new cost base. This company is running as efficiently as it can. Are there gains to be had if you scale it up? Or quite frankly, is it optimized and it's just a question of is more volume than efficiency moving forward? If you process more, or will you be producing at the same margins, or can there be additional gains through scaling up?
No, there's always gains to scaling up, but there are limits, and then it takes capital to make that scaling up. And, you mentioned Project 250 early on. At the end of the day, we decided that Project 250 was just not practical because the way capital costs went up. So a project that we thought was going to be 15 to 20 million was all of a sudden, 50 to 60 million. And then you look at it and you go, actually, there's no benefit to that.
Yeah.
So we had to pull in our horns. And to be quite honest, we were having trouble getting to 200,000. So it was a matter of, let's learn to walk before we run.
Right. And you talk about capital costs out. In case there's some younger listeners listening to this, we've talked about the increased costs around, from inflation and COVID supply chain issues, etc. But capital cost, the cost of the money you need to borrow, or would need to borrow, is significantly more than it was 3 years ago. That's what you're saying, right?
Yeah. Well,
so it
was, SOFA is the new term, which is around 5%.
Yeah.
Plus, say, 2.5%. 4 years ago, SOFA was less than 1%. So interest rates have gone from 2.5% to 7.5%.
Right. I think most people we can probably think about
Anybody
that.
That has a house mortgage.
Mortgage thing, right? Okay,
Yeah.
so you didn't like 1% was okay, and 7% now you don't like it so much. Imagine that, but times a much bigger number. Okay, so but if you wanted, not that you do, but are there homes for money for good projects in terms of you've got a good shareholder base, you've got some good institutional guys and gals in there. In terms of projects like yours, which are producers, they are throwing off money, they are being run efficiently. Is there new money, generalist money coming in? Or are people just sitting on their money waiting for it to see who survives this weathers the storm? I mean, is the money there anymore?
Yeah, I think it is. The successful hedge funds are still successful at raising money, whether it's for university endowments or whatever. But, our partners in the beginning were Orion Mine Finance. They did very well on Victoria and the development of Eagle. And whenever I see the executives there, they say, hey, find us another project. We've got a check for $250 million for you. So they want to support good projects and good people.
Okay.
And so I think the money's there. There's just not good projects out there right now.
Certainly not a lot of new production coming through. But and talk to me what you're going to do for your company. So again, for shareholders, for potential shareholders, it's been a tough ride for you guys, and precious metals more broadly, last 2.5 years, okay? No question about that. But people are looking to you as a CEO to say, right, we've got a plan, we continue to produce the ounces, we will produce them more efficiently. If we do, I don't know, X, Y, Z, you should be valuing us differently from where you are now. You're just a $400 million company now. There's a $1 billion company a while back. So nothing's changed, it seems, except the market. So how do we value you?
Well, I think, we are in the penalty box. Let's face it, we missed guidance 3 years in a row. We've made our own guidance 3 quarters in a row, but I think the market's waiting for us to, demonstrate to us that the mine really is running well and you're paying down debt and... we'll get rewarded and we'll see a re-rating in our share price.
Right. And what does that convert into? Because you're targeting, what you said, 160 into this year, top end, in terms of the range?
Our guidance is 160 to 180.
160 to 180. That's
We'll be just below the midpoint of that.
Okay. So that's not too bad. But it's a decent sized company, right? Are you gonna? What are the other things that you got to show? What should I be looking at to be able to judge you and say, look, they missed guidance for the last 3 years, but the market's been tough for the last 3 years, and costs have been significantly increased the last 3 years, and lots of equipment and people have been hard to come by. All the kind of excuses that all companies can throw on the table, but what do you want to be judged on? What's important?
I think our production record at Eagle's the most important thing to be judged on.
Right.
I can't really do anything about the price of gold.
Right.
I wish I could, but I can make sure we produce gold for the lowest possible cost per ounce.
Right.
And that's our aim.
Right. So judging on the production, do you mean ounces or the fact that you can actually produce? When you say it, what do you mean?
Yeah, I think that we can produce gold and meet guidance efficiently.
Okay. So this year, guidance, we're going to hit it. I like it.
Yeah.
Good man, John. Good man. You're one of the few guys actually out there producing gold at the moment. So not too bad, really. Not too bad.
Well, I go to a lot of these conferences like the Zurich show, and we were the only producer there. And
a lot of chat.
I feel very sorry for a lot of these juniors that are on their last $500,000 and have no opportunity to raise money right now.
I think so. I think just in terms of market, the explorers have got 1 in 3,000 chance of finding an economic discovery. You've got a lot of value. It's a lot of value destroyed by those companies in a good market or bad. But in a market like this, I feel sorry for retail. They've kind of bet and in whatever size they've bet on these companies, because it's going to be hard for these guys to get through this without capital. I see a lot of M&A, and I see a lot of these projects going back in the back of the drawer.
You think there should be a lot of M&A,
yeah,
but we haven't seen it in the junior space. Yeah. And I fear that a lot of the juniors don't have enough money now to do any M&A.
Yeah,
there's a cost to it, legal, regulatory.
Yeah.
And if you're down to your last $100,000 in the treasury, you can't merge with another company.
Okay, you be honest with me here. You see, like I'm quite candid with my guys. I say 70% of the stuff we see is utter rubbish. We'll never produce a damn thing ever. These assets fundamentally go around the ringer, and they kind of get pulled out each cycle. Say, right, this time it'll work. Do you think the same? When you look around, you're a producer now, you can look back and go, I've been there, so I know what you're going through. But do you look at some of these explorers and just go, I do not know how you got this far?
Yeah, no, definitely. And, I wish they had closed their offices and moved into their garages 6 months ago and, saved some money, because things will come around. It's a cyclical business, and markets are cyclical. But I think a lot of juniors have put themselves in such bad space that they'll never recover.
It's not their money, right?
No.
Not their money. John, good to see you, man. Thank you.
Cheers.